There is a number every retiree has heard: $250,000. Banks mention it. Financial articles mention it. Friends mention it. Even the sign at the teller window may make you feel like your money is safe. But here is the part many retirees misunderstand. The $250,000 limit does not simply mean, I can keep $250,000 in the bank and everything above that is unsafe. And it also does not mean, every account I open gets a fresh $250,000 of protection. Both ideas can be wrong. The real rule is more specific. It is usually $250,000 per depositor, per insured bank, per ownership category. That last part, ownership category, is where many seniors get confused. Because your checking account, savings account, money market deposit account, and CDs may all be added together if they are owned the same way at the same bank. So a retiree can look at 5 separate accounts and think, I am protected 5 times. But the system may look at those same 5 accounts and say, this is one ownership category. This does not mean you should panic. It means you should understand exactly how the limit works before you move retirement savings, sell a home, renew a CD, inherit money, or park extra cash in one bank. Because the mistake is not always having too much money. The mistake is thinking the money is protected in a way it may not be. For retirees, bank safety feels personal. This is not gambling money. This is not extra money sitting around for fun. This may be the money from a lifetime of working, saving, selling a home, receiving life insurance, downsizing, cashing out investments, or holding emergency funds for medical costs, property taxes, assisted living, or helping a spouse. So when a senior hears the words FDIC insured, it creates relief. And in many cases, that relief is deserved. FDIC insurance is a powerful protection when money is held in an insured deposit account at an insured bank. Credit unions have a similar protection system through NCUA share insurance for federally insured credit unions. But protection depends on structure. That is the part people miss. The question is not just, is my bank insured? The better question is, how are my accounts titled, what ownership category are they in, and how much total money do I have in that category at that bank? Because the difference between those questions can be the difference between being fully covered and having uninsured money. This video is especially important if you recently sold a home, keep large CDs, have a joint account with a spouse, named beneficiaries on bank accounts, opened accounts at different branches of the same bank, moved money after a spouse died, or hold retirement cash at a bank. And it matters even more if you are widowed, remarried, helping an aging parent, or keeping money in the bank because you are afraid of market risk. Bank safety is not only about the bank, it is also about the paperwork. Let's begin with the first myth. Many retirees believe each bank account gets its own $250,000 limit. That sounds reasonable. If you have a checking account, a savings account, a money market account, and 2 CDs, it feels like 5 separate accounts. You may look at the list and think, I would never put more than $250,000 in one account. But FDIC insurance usually does not work by simply counting accounts. It looks at the depositor, the insured bank, and the ownership category. So if one retired woman named Helen has a checking account, a savings account, and 2 CDs at the same insured bank, all in her name alone, those accounts may be added together under the single ownership category. The bank may show 4 separate lines on her statement. The insurance calculation may see one combined total. That is where retirees get caught. Not because they were careless, because the bank statement made the money look separated, but the insurance rule may treat it as grouped. Here is a simple example. Helen has $40,000 in checking, $90,000 in savings, $100,000 in a CD, and $80,000 in another CD. Each account is under $250,000, but together they equal $310,000. If all of that is in Helen's name alone at the same insured bank, she may only have $250,000 insured in that ownership category, leaving the extra amount potentially uninsured. The dangerous part is that nothing looks wrong. The accounts are real. The bank is real. The FDIC sign is real. The mistake is not the bank account. The mistake is assuming separation on the statement means separation for insurance. Now let's look at the second myth. Many retirees think different branches mean different banks. Imagine a couple has money at First County Bank on Main Street. Then they open another CD at First County Bank across town because the rate was better. Then they open another account online through the same bank because the website offered a promotional rate. To them, these feel like different places, different branch, different banker, different account number, different login screen. But if it is the same insured bank, those accounts may still be counted together. A different branch does not automatically create a new insurance limit. This is very important for seniors who like to keep everything local. You may have one account near your home, one near your daughter's house, and one opened online. But if they are all under the same insured bank and the same ownership category, the totals may be combined. The protection does not follow the building. It follows the insured institution and the ownership category. Before you assume you are spread out, check whether you are actually using separate banks or simply separate branches of the same bank. The next myth is the opposite mistake. Some retirees believe they can never have more than $250,000 at one bank and still be insured. That is not always true either. The $250,000 limit is not always a hard ceiling on the entire relationship with one bank. In some cases, a person may qualify for more coverage at the same insured bank if the money is held in different ownership categories and the requirements are met. For example, money in a single account may be insured separately from money in a joint account. Certain retirement accounts may have their own category. Trust or payable on death accounts may have different rules based on owners and eligible beneficiaries. This is where the rule becomes more powerful, but also more confusing. A married couple may have a joint account that receives coverage based on each co-owner's share if the account meets the requirements. A person may also have single accounts in their own name, and those single accounts may be calculated separately from properly structured joint accounts. But this does not happen by accident. The account titles matter. The ownership records matter. The beneficiaries may matter. The category requirements matter. This is why I have more than $250,000 at one bank is not enough information. The real question is, how is that money owned? Now let's talk about joint accounts, because this is one of the most misunderstood areas for retirees. A husband and wife may have a joint account with $500,000. They may worry because the balance is above $250,000. But a properly structured joint account can receive coverage of $250,000 per co-owner. That means a qualifying joint account with two co-owners may be insured up to $500,000 in that ownership category at that bank. But here is the warning. This does not mean you can simply add a child's name to an account casually and solve everything. Adding a child as a joint owner can create other problems. That child may gain withdrawal rights. Their creditors, divorce, lawsuits, or financial problems may create complications. It may affect inheritance expectations. It may create confusion with siblings. And if the person is added only for convenience, the account may not match what the parent actually intended. So yes, joint ownership can affect insurance coverage. But joint ownership is not just an insurance trick. It is a legal and financial decision. Before adding someone to a bank account, especially an adult child, ask what rights that person receives, what happens if they withdraw funds, what happens if they die before you, and how the account will be treated after your death. The next myth involves beneficiaries. Many retirees see POD or payable on death and assume it automatically means unlimited protection. It does not. Beneficiaries can increase deposit insurance coverage in certain trust account structures, but only within specific rules and limits. A payable on death account, in-trust for account, living trust account, or other trust type account may receive coverage based on eligible beneficiaries, subject to requirements. But the details matter. The names must be properly recorded. The beneficiaries must be eligible. The accounts may be combined with other trust accounts at the same bank for the same owner, and there are maximums. So a retiree should not assume, I named my 3 children, so everything is automatically fine, without checking the actual calculation. There is also a family danger here. Beneficiary designations on bank accounts can bypass what people assume will happen under a will. If your will says everything is divided equally, but one bank account names only one child as beneficiary, that bank account may not follow the will the way your family expects. So the beneficiary line is doing 2 jobs. It can affect deposit insurance, and it can affect who receives the money after death. That is why retirees should review bank beneficiaries with the same seriousness as a will or trust. Do not guess. Do not rely on memory. Ask the bank for confirmation of how each account is titled and who is listed as beneficiary. Now let's discuss retirement accounts at banks. This is another area where retirees can misunderstand the $250,000 rule. Some seniors have IRA CDs or other deposit-based retirement accounts at a bank. They hear retirement account and assume it is treated the same as a brokerage account or protected without limit. But FDIC insurance at a bank applies to insured deposit products, not every financial product that might be connected to retirement. Certain retirement deposit accounts, including some IRAs held in insured deposit products, have their own insurance category, generally up to $250,000 per owner at the same insured bank. But the word retirement alone does not mean everything is FDIC insured. Stocks, bonds, mutual funds, annuities, life insurance policies, crypto assets, and other investment products are not FDIC insured just because they were purchased through a bank or discussed in a bank office. This is a major senior trap. A retiree walks into a bank. They trust the building. They trust the logo. They think everything offered there has the same government-backed protection as a checking account, or CD. But FDIC insurance is for deposit products at insured banks. It is not protection against market loss. It is not protection against a bad investment. It is not protection against fraud. It is not protection against the value of an annuity, mutual fund, or stock going down. So the question should always be specific. Is this money in an FDIC insured deposit account? Or is it in an investment or insurance product sold through or near the bank? That difference matters. Now here is the myth that creates quiet exposure after a major life event. My spouse handled this years ago, so I'm sure it is still fine. Deposit insurance coverage can change when life changes. If your spouse dies, accounts may move from joint ownership to single ownership. If beneficiaries change, trust coverage may change. If a CD renews, if a bank merges, if you move money from one account to another, if you sell a home and park the proceeds temporarily, your coverage picture may change. A surviving spouse can be especially vulnerable. For years, a couple may have been safely structured. Then one spouse passes away. The widow or widower keeps the same bank, same accounts, same CDs, same routine. But the ownership category may no longer be the same. What was once joint may become single. What was once covered under two owners may now be calculated under one owner. And if life insurance, home sale proceeds, or inherited funds are added to the same bank, the balance can quietly grow above the insured limit. This is not the widow's fault. It is a paperwork shift, and paperwork shifts can change protection. So after the death of a spouse, do not only ask, "Can I still access the money?" Also ask, "How is this money insured now?" The next myth is about CDs. Many retirees love CDs because they feel safe. And compared with market investments, CDs at insured banks can be a conservative tool. But CDs still count toward deposit insurance limits. The danger comes when a retiree chases rates at the same bank without realizing that multiple CDs may be added together. One CD for $100,000, another CD for $150,000, another CD for $75,000. Each one looks separate. Each one may have a different maturity date. Each one may even have been opened months apart. But if they are owned the same way at the same insured bank, they may be added together in the same category. The maturity date does not create a new insurance category. The CD number does not create a new insurance category. The promotional rate does not create a new insurance category. That is why rate shopping must be paired with insurance checking. Before renewing a CD, ask, "How much do I already have at this bank in this ownership category?" And remember to include accrued interest. Because FDIC coverage includes principal and accrued interest up to the applicable limit. A retiree may carefully deposit exactly $250,000 into a CD, then forget that interest can push the balance over the limit. That does not mean you should avoid CDs. It means you should track the total insured balance. Now let's talk about credit unions. Many retirees use credit unions instead of banks. Credit unions can also have federal insurance through the NCUA, but the terminology is different. Instead of FDIC deposit insurance, federally insured credit unions are protected by NCUA share insurance through the National Credit Union Share Insurance Fund. The basic idea is similar. Coverage is generally based on the owner, the insured credit union, and the ownership category. But do not assume every financial institution is covered just because it looks safe or uses friendly language. Confirm whether the credit union is federally insured. Check your account categories. And remember that different branches of the same credit union do not automatically create separate coverage. The same misunderstanding can happen in a credit union as in a bank. The sign is reassuring. The staff is friendly. The accounts look separate. But the insurance calculation still follows rules. Now let's explain the most important protection step. Use the official calculator. The FDIC provides an online tool called EDIE, the Electronic Deposit Insurance Estimator, to help calculate deposit insurance coverage. This is not something you should try to figure out only in your head if you have multiple accounts, joint owners, beneficiaries, trusts, CDs, or retirement deposits. A 5-minute estimate can reveal a problem before it becomes an emergency. You can also ask your bank for a deposit insurance review, but be careful with vague answers. Do not only ask, "Am I FDIC insured?" That question can produce a comforting but incomplete answer. Ask instead, "Based on my account titles, balances, beneficiaries, and ownership categories, how much of my total money at this bank is insured?" That is a much better question. And ask for the answer in writing or with a clear breakdown if possible. You want to know which accounts are grouped together, which are separate, and whether any amount may be uninsured. The same idea applies at a credit union. Ask for a share insurance review based on your exact accounts. Now let's talk about what retirees can do if they discover too much money is uninsured. First, do not panic and rush into a bad decision. Moving money too quickly can create mistakes, fees, lost interest, tax consequences, or exposure to scams. Second, consider spreading deposits across different insured banks or federally insured credit unions. Money at different separately insured institutions may receive separate coverage. But make sure they are truly separate institutions, not just different branches or different brand names under the same insured bank. Third, review ownership categories. In some cases, single, joint, retirement, and trust accounts may provide separate coverage if structured correctly. But do not create joint accounts or beneficiary arrangements only for insurance without understanding the legal and estate consequences. Fourth, be careful with investment pitches. If someone says, "You are over the FDIC limit, move this into an annuity, market-linked product, or high-yield investment," slow down. That may or may not be appropriate for you. But it is not the same as deposit insurance. Do not trade an insurance limit problem for an investment risk problem you do not understand. Fifth, update your plan after major events. Selling a home, receiving an inheritance, losing a spouse, closing a business, moving into retirement, changing banks, opening CDs, adding beneficiaries, creating a trust. These events should trigger a deposit insurance review. Because the bank limit is not something you check once and forget forever. It changes when your money and paperwork change. Here is a simple review you can do this week. First, list every deposit account you have at each bank or credit union. Checking, savings, money market deposit accounts, CDs, cashier's checks, and deposit-based retirement accounts. Second, write down how each account is titled. Single name, joint account, trust account, payable on death account, IRA, business account, or another category. Third, write down the current balance and include interest that may have accrued. Fourth, list the beneficiaries on each account, if any. Do not rely on what you think you named years ago. Ask for confirmation. Fifth, group accounts by institution and ownership category. This is where many surprises appear. Sixth, use the FDIC calculator for bank deposits or contact the NCUA or your federally insured credit union for share insurance questions. Seventh, speak with a qualified financial, tax, or estate planning professional before changing ownership, adding children, changing beneficiaries, or moving large sums. Because deposit insurance is connected to estate planning more than many retirees realize. A beneficiary change can affect coverage. A joint owner can affect coverage. A trust can affect coverage. But those same changes can also affect inheritance, control, taxes, family conflict, and access after death. So the goal is not just to be insured. The goal is to be insured in a way that matches your real family plan. The $250,000 bank limit is not as simple as many retirees think. It is not always $250,000 per account. It is not always $250,000 total per person, no matter what. It is generally $250,000 per depositor, per insured bank, per ownership category. That means the way your accounts are titled can matter as much as the amount of money inside them. A checking account, savings account, money market deposit account, and CD may be combined if they are owned the same way at the same bank. Different branches of the same bank may not give separate coverage. Joint accounts may provide more coverage if they meet the rules. Trust and payable on death accounts may increase coverage, but only under specific requirements and limits. Certain retirement deposit accounts may have a separate category, but investments sold through a bank are not automatically FDIC insured. And after major life events, especially the death of a spouse, your coverage may change without the account looking different on the surface. So do not let the number $250,000 give you either false fear or false comfort. Use it as a reason to check, because the safest retiree is not the one who assumes everything is fine. The safest retiree is the one who knows exactly how the accounts are titled, how the balances are grouped, and what is actually insured. This is not about panic. It is about preventing a quiet paperwork mistake from putting retirement savings at risk. If you want a simple checklist of what to review at your bank, comment "bank" below. And share this with a retiree, widow, or adult child who helps with family finances, because one account review today can prevent a painful surprise later. Before you move money, add a joint owner, change beneficiaries, or restructure accounts. Check the official FDIC or NCUA information and speak with a qualified professional who understands your full situation.